Let's have a look at some important facts regarding capital gains tax. When you dispose of an asset, you only pay capital gains tax on the profit you make when you dispose of the asset. You do not pay capital gains tax on the sale price. A portion of the profit will be added to your normal income for tax. If you make a capital gain loss, then no part of the loss may be deducted from your income. A capital gain loss may only be used to reduce capital gain profits on the disposal of other assets. An overall CGT loss may not be used to reduce normal taxable income, but may be carried forward, and that loss may be used to reduce the profit on any assets you dispose of in future. Capital gains tax was introduced on the 1st of October 2001. And CGT is only applicable on assets disposed of after 1st of October 2001. If you bought an asset before that date and disposed of it now, then no CGT applies to the portion of the profit attributable to the period before 1st of October 2001. Only the portion of the profit attributable to the period after this 1st of October 2001 valuation date is liable for capital gains tax. If you bought an asset before the valuation date 1st of October 2001, then you had the option of getting the asset appraised or valued on the valuation date. If you did not, then you will use a set of complex formulas in the 8th schedule to work out what SARS calls a time-apportioned base cost or deemed value on the 1st of October 2001, and this value is used as the base cost. Basically, the difference between the base cost and the selling price is the profit amount liable for capital gains tax. Of course, if you acquired the asset after 1st of October 2001, then your profit for CGT is far simpler to work out. It is the selling price less the purchase price less improvements, acquisition and sale costs. Not all of the profit will be taxable. If you are a personal taxpayer, then the total profits of all capital gain transactions will be added together, and the first 30,000 Rand of the total profit is exempt as your annual exclusion. Only 33.3% of the balance will be added to your normal income for tax. Note that this is 33.3% and not 1/3. If you are married in community of property, then you and your spouse each get half the profit and you each get 30,000 Rand annual exclusion. Note that if the asset is a primary residence, then the primary residence exclusion applies to the property and not per spouse married in community of property. Note that if someone dies during the tax year, then a normal assessment must be prepared for the period in the tax year up until the day the taxpayer died. If the taxpayer had any CGT events during the tax year while he or she was alive, then the annual exclusion is 300,000 Rand. Some of the things affected by capital gains tax in South Africa are shares and unit trusts, land, property and rights to property, holiday homes and timeshare, large boats over 10 meters in length, aircraft weighing over 450 kilograms, certain coins and the buying and selling of certain policies. Some of the assets exempt from CGT are private vehicles, clothes, jewelry, stamps, art, antiques, personal goods, etc., as well as payouts from policies like RA, pension, provident funds, etc. Let's see how capital gains tax calculations work by going through some simple examples. I could use something simple like a spreadsheet to illustrate examples, but it is easier to explain by using the CGT calculator screen in the WinTax software. This is the calculator we're going to use to explain capital gains tax transactions. Of course, if you have a certificate from a trust or an investment fund showing the base cost, the proceeds or the selling price and the gain or loss, then you certainly don't need a fancy calculator, as all the amounts you need are on the certificate for you, ready to enter on the ITR 12. However, you'll probably need a lot of help working out the gain amounts on other types of assets, because it can get quite involved. Different exclusions and exemptions apply to the disposal of different types of assets. So the nice thing about this calculator is that we can simply click on these buttons here to select the type of asset, and all the rules change. You can see that we've selected this particular asset as an other asset, as it is a second property opposed to a primary residence or a small business sale. Looking at this first very simple example, we can see that we bought this holiday house for 2 million rand and sold it for 4 million rand. So we made a profit of 2 million rand. The profit that SARS wants you to enter on the ITR 12 as code 4250 is the 2 million rand. SARS will apply any community of property splits, annual exclusions and inclusion rates. If we slide the screen away, we will see the calculator has placed the 2 million rand profit under code 4250. The calculator has also subtracted the annual exclusion of 30,000 rand and worked out 33.3% of the balance of 1,970,000 as being 656,010 rand that needs to be added to normal taxable income. It is important that you know that this amount added to taxable income is added after deduction claims such as the RA 15% rule claim are worked out. So please note that the additional capital gain amount added to normal income may not be used as part of taxable income in the RA 15% rule. Sliding our calculator screen over again, we can see that the property was bought after capital gains tax came along in 2001. So working out what SARS calls the base cost and the profit is very simple. The base cost is the purchase price and the proceeds are the sale price. The proceeds less the base cost is the profit or gain. You may claim acquisition costs such as registration costs, legal fees to prove ownership of the asset, etc. Improvement costs you may claim do not include maintenance expenses. If you fix the garage roof, then that is maintenance and you cannot claim it. But if you built an additional garage, then that is an improvement and you can claim that. Now what if we bring other costs and expenses into the example? Now what we've added here is we've added 100,000 rand for acquisition costs and we've added 100,000 rand for sale costs. What effectively happens here is that these amounts are taken off our profit, and you can see our gain is reduced from 2 million rand to 1.8 million rand. Now what if we bought this asset for 1 million rand before capital gains tax was introduced on 1st of October 2001 and sold it for 3 million, giving us a profit of 2 million rand. Remember that only the portion of the profit which applies to the period after 1st of October 2001 is subject to capital gains tax. Here I've changed the figures. We can see the date acquired was the 8th of August 2000. The purchase price was 1 million rand. We had the property valued on the valuation date on the 1st of the 10th 2001 and it was valued at 1.2 million. Here's our date of sale, 6th of June 2015, and there's our selling price of 3 million rand. This 1.2 million rand valuation is now our base cost. So the selling price less the base cost gives us our gain of 1.8 million. Now what if we never had this valued on the valuation date of the 1st of October 2001? So let's delete the appraised value. The calculator has worked out a deemed value on 1st of October 2001. How did it do that? Well, it's a bit simpler than it may seem. You have to work out the total period of ownership of the asset and then proportion the profit over the whole period of ownership by the period before 1st of October 2001 and for the period after that. You count the number of years before the valuation date and after the valuation date. But remember that part of a year, even one day, counts as a full year. From the 8th of August 2000 to the 1st of October 2001 is counted as 2 years. From 1st of October 2001 to the 6th of June 2015 is counted as 14 years. 2 years before the valuation date plus 14 years after the valuation date makes 16 years. If we divide the 2 million profit by 16, we get 125,000 Rand profit per year. Add 125,000 for each year of ownership before 1st of October 2001 to the purchase price. This means we add 250,000 to the 1 million Rand purchase price and we get a calculated or deemed value base cost on 1st of October 2001 of 1,250,000. Subtract this calculated base cost from our selling price of 3 million and we get our gain of 1,750,000 Rand. Now SARS has fine-tuned these rules a bit over the years and factoring in expenses and costs has become a bit simpler. For example, any acquisition costs and improvements made before the valuation date are now treated as if they were incurred on the date of purchase. If we say that acquisition costs and improvements before the valuation date are 100,000 Rand each and we reduce the purchase price by 200,000, there you can see I've added 100,000 Rand acquisition costs and 100,000 Rand improvements before the valuation date, and I've reduced the original purchase price from 1 million to 800,000. And then we can see our answer is exactly the same. The calculator has added the 200,000 Rand expenses to the new purchase price of 800,000 to make 1 million, so the gain answer is the same. Let's change everything back. The same sort of thing applies with sale costs. They are deemed to have taken place on the date of sale. If we add sale costs of 100,000 Rand and increase the sale price by the same amount, we can see our answer is unchanged. There you can see the sale costs 100,000 Rand and I've increased the selling price to 3.1 million, but our capital gain remains exactly the same. However, if we add improvements made after the valuation date, then this does not just alter the sale price. The formulas in the 8th schedule amortize the 100,000 Rand over the period by effectively shifting the valuation date in the background and producing a new base cost, which means a new gain amount. If you want to use these formulas manually, then the formulas are freely available in the 8th schedule and on SARS's website in a document called Comprehensive Guide to Capital Gains Tax. Now let's have a look at a completely new set of figures. We can immediately see that the amount going towards capital gains tax has dropped from 3 million to 1 million. This of course is because the profit on a primary residence sale qualifies for a 2 million Rand exemption. If it is sold for less than 2 million Rand, then capital gains tax does not apply at all, and this is an important thing to remember. Also, with a community of property primary residence, the exemption of 2 million Rand applies to the profit on the property, and the remainder is split 50-50 between the spouses, who each qualify for a 30,000 Rand annual exclusion. The primary residence exclusion is per property, however, and not per spouse married in community of property. Now let's discuss partnerships. And I'm not talking about community of property splits here. I'm talking about actual partnerships owning an asset. We can use this very simple example on the screen right here. What if 5 young people came out of varsity and bought a house together? They all live together in the house and it's their primary residence. They each have a 20% share. Here you can see I've changed the percentage share to 20%. What happens when they sell the house one day? Who gets what share of the 2 million rand primary residence exclusion, and who pays what share of the capital gain? Well, the law says that each person who has a financial share in the asset shares in the 2 million rand primary residence exclusion and shares in the gain for capital gains tax. This means that each partner winds up with a 20% share in the 1 million rand profit. If this partner we are concerned with here was married in community of property, for example, then his 200,000 rand gain amount would be split between him and his wife equally. Now I just want to get rid of the partnership and change the selling price here to 2.6 million. Now I've got rid of the partnership. I've changed the purchase price to 2 million and the sale price to 2.6 million. Okay, we have no gain because of the 2 million rand primary residence exclusion on the profit of a primary residence. The profit is only 600,000 in this case, and the 2 million rand exclusion means there's nothing in the profit to go for capital gains tax. I just want to draw your attention to this field here, where we can enter the size of the property. I'm going to enter a size of 3 hectares and see what happens to the gain. Suddenly we have a gain of 200,000 rand. Why? Well, the law regarding the 2 million rand primary residence exclusion on the profit of a primary residence says the 2 million rand exclusion applies to so much of the property as does not exceed 2 hectares. Because this property was 3 hectares in size, that means 200,000 rand profit per hectare. The 2 million rand exclusion applies to the profit on the first and the second hectare, but the 2 million rand profit on the third hectare stands on its own and it's liable for capital gains tax. Using this completely new example, our same laws apply to primary residence with regard to determining the base cost. We bought this primary residence for 1 million rand in August 2001 and had it valued at 1.2 million on the valuation date, the 1st of the 10th, 2001. This 1.2 million rand becomes our base cost, and so the profit of 5.8 million becomes 3.8 million after the 2 million rand primary residence exclusion. If we remove the valuation and use the tab method, we can see our gain amount changes as we now have a new time apportioned base cost. There's one final method that SARS uses to determine the base cost in cases where you cannot prove when you acquired the asset or what you paid for it. If we remove the purchase date and the purchase price, then you will see that SARS uses the 80% 20% method, which means that SARS uses 20% of the proceeds as the base cost. In this case, 20% of 7 million selling price is 1.4 million. 7 million less the 1.4 million base cost is 5.6 million profit. Less the 2 million rand primary residence exclusion means a gain amount of 3.6 million. I just want to point out 2 things here. Firstly, the 20% 80% rule method is very expensive and you want to avoid having to use this method. Secondly, if you bought a property before the valuation date and lodged a valuation for the property with SARS at the time, then you have to use the value even if the tab formula happens to reveal a better base cost when you eventually sell. SARS does not allow you to cherry pick which valuation you want to use. Here we have a primary residence which we bought in 2005 for R1 million and sold recently for 2.5 million. With a profit of 1.5 million and a primary residence exclusion of 2 million rand, we would expect zero capital gain, but we can see a capital gain of 150,000 rand. You see, with the residency period in the equation, the primary residence exclusion pretty much goes out of the window unless the residency percentage multiplied by the profit exceeds the primary residence exclusion. In this case, 90% of the 1.5 million profit is 1.35 million, which is less than the 2 million rand primary residence exclusion. This means that we ignore the primary residence exclusion and the amount for capital gain is the non-residency period of 10% of our profit of 1.5 million. What happened in this particular case is that we rented out 10% of the house and we had residents of 90% of the house. Maybe we even rented out 10% of our house to our private business while we lived in the other 90% of the property. Anyway, you can see here that our gain amount is the 10% of our 1.5 million profit, so our amount for capital gain is 150,000 rand. Let's have a look at a case where we made a bigger profit. I'll change the sale price to 32 million. Here you can see that the residency period of 90% times the profit of 31 million is more than the 2 million rand primary residence exclusion. So our capital gain is the profit of 31 million less the 2 million rand primary residence exclusion as normal. Only when the residency period percentage times the profit is less than the 2 million primary residence exclusion does the 2 million rand exclusion fall away, and our amount for capital gain is the non-residency period percentage of the profit. With our selling price back to 2.5 million, let's recap. We can see we had residents for 90% of the time and we had non-residents for 10% of the time. If 90% of the profit was less than the 2 million rand primary residence exclusion, and we can see that 90% of 1.5 million is less than 2 million, then we ignore the primary residence exclusion and our gain is 10% non-residency period of the profit, which is 150,000 rand in this case. Starting again with a different taxpayer who started a small business in 2005 with 1,000 rand and sold it recently for 3 million rand. We can enter these details as well as acquisition costs, improvements, etc. into the capital gains tax calculator, and it will work out our profit for capital gains. We may be entitled to a deduction of 1.8 million once in a lifetime depending on conditions. So let's go through some of the fine print as it's shown here when you click on the info button. Now clicking on this info button down here in the bottom right will bring up a text box giving us the basic information on the sale of a business. Now getting rid of the text box. The first 1.8 million of profit on a small business is exempt from capital gains tax, provided that you're either over 55 or you were forced to sell the business because of ill health. The exemption is per person and not per business. The total value of all the taxpayers' businesses must not exceed 10 million rand. In the case of a partnership, each partner may be entitled to a 1.8 million deduction, provided that the sale of the business is finalized in 2 years. Any unused portion of the exempt amount may be carried forward to a possible future business sale, provided that the total value of all sales are less than 10 million rand. Selecting the stocks and shares option, we enter that we bought shares in the year 2000 for 100,000 rand. Along came the events of 9/11 in September 2001, and we were lucky that our shares only lost 50% on 1st of October 2001, and they were valued at 50,000 rand on the valuation date October 2001. Let's say they never completely recovered and we sold them for 80,000 rand in 2015. According to the law, we should be liable for a capital gain amount of 30,000 rand between the base cost of 50,000 and the selling price of 80,000. This hardly seems fair, as overall we lost 20,000 rand. SARS agrees, and the loss limitation clauses in the Act say that there is no gain in a case like this. The calculator we are using caters for these laws and shows no gain.